Sasha Elenko here. I help write and produce the Reconnect America podcast. If you follow the US freight rail industry, if you listen to this podcast, you've probably heard about precision scheduled railroading, or PSR, the operating model that has dominated the industry for the past decade or so. Now, it's safe to say that PSR has been great for railroad shareholders and overwhelmingly unpopular among the countless businesses that depend on railroads to move their freight. But beyond that, and perhaps because of this antagonism, it can be difficult to get a clear picture of what PSR actually is. Does it consist, as railroads claim, of a Spartan commitment to hyper-punctuality, always prioritizing adherence to the schedule over the length of trains? Or is the shipper view that PSR has nothing to do with precision or scheduling, and that it's really mostly about running fewer, longer trains, the correct one? Of course, exaggeration is to be expected in branding, but with such diametrically opposed accounts, one struggles to imagine how shippers and railroads could even be referring to the same thing when they talk about PSR. To better understand the source of this divide between how PSR is advertised and how it is experienced, we got in touch with John Strong. He's the CSX professor of finance at the College of William and Mary in Williamsburg, Virginia. Though his position is endowed by the railroad CSX, Professor Strong was quick to clarify that he is not otherwise affiliated with the railroad and that he does not speak on its behalf. In addition to delving into the nuts and bolts of PSR, its aspirations, its pitfalls, and its contradictions, this conversation between Professor Strong and Reconnect America host Bill Moyer also explores the context out of which PSR arose and the forces that have pushed it to the fore of the US railroad industry along the way. From railroad deregulation to financial deregulation to the globalization of supply chains, what emerges is a comprehensive picture of how the pressures and incentives surrounding US railroads have evolved over the past half-century, and the implications this has had for the role that this critical national infrastructure plays in the economic life of shippers, communities, and the country as a whole. Here is Bill Moyer's conversation with Professor John Strong.
Do you prefer Professor or Dr. Strong?
Whatever you want. I usually teach executive MBA students, so John is what I go by. So John is fine.
Okay.
One thing I just was going to mention before we get started, I am the CSX professor of finance at William and Mary. I don't have any direct involvement with CSX. I've had some way back in the past, but CSX endowed a bunch of professorships. I happen to have one of the professorships. It happens to be related to transportation, which is what I work on. And so that's why I have it. But CSX professor doesn't mean I'm speaking for CSX.
Okay, well, that's good to know. We appreciate that because we're counting on it not to be the case. It might be fun. Well, we could either just use what you just did, or you could just introduce yourself.
That sounds good. So when I was in grad school, it was the time period where all the industries were being deregulated: airlines, banking, trucking, rail. And when you're sort of in grad school and PhD program in finance and economics, all of the changes in deregulation were like the great place for a young graduate student to be involved in things. And so in the early 80s, I got involved, and I've been working 40 years in various transportation, from airlines to rail to ports and so on, both in the US and around the world.
Right on. Well, that's great to know. And could you say a little bit more again about the position that you have at the university and what you do there?
So I'm the CSX professor of finance at the College of William and Mary in Williamsburg, Virginia. I've been there for the full 40 years. I've been on leave for some different sabbaticals over that time, but I teach finance and economics to MBAs and graduate students, executive MBAs as well.
Fantastic. We really appreciate you coming into this. My co-producer, Sasha Elenko, have been reading some of your work, and then he shared it with me. And I just haven't seen very many people do quite as clear a description of what precision scheduled railroading actually is or is not, and how it emerged and its impact. So I'm hoping today that we'll spend our time talking about the deregulatory process, because this upcoming episode we're piecing together is trying to trace staggers to the present day. And we'd really like to focus with you on the moment leading up to staggers and the moment of Staggers Act and the deregulation and what that meant for the railroads, how the changes in the deregulation of finance, for instance, with the SEC making shareholder buybacks actually a legal thing to do. What we'd like your help navigating and trying to describe is the moment of staggers, what that opened up for railroads in terms of revenue adequacy or saving railroads from their pattern of bankruptcy, potentially what we lost from that, but more like what happened at first, the phenomenon of the consolidation, then unit trains, and eventually then we'll get to when does PSR emerge and what were the impacts of that, and to what extent is that a real thing, and to what extent is that another name for profit maximization.
I guess where I would start is if you think back about the history of railroad regulation, it was really designed to deal with two things, right? One was monopoly power, and the second was managing restructurings of the industry that came from financial instability. And so that sort of went through the first 40 or so years of the ICC. When we came out of the First World War, after the railroads had been nationalized, we had now a newly reprivatized rail system that was seen as having a lot of power. And so we controlled minimum and maximum rates. We controlled services. We controlled entry and exit on services. We controlled abandonments. So it was soup to nuts when it came to sort of economic regulation, and in many ways sort of was the model for regulation of other sectors. The consequence of that was that just at the time that all of that was being set up, we were starting to build a national paved road system, and it was the development of trucking. So from the 1920s through the 1970s, essentially was a long period of decline where a rigidly regulated rail system couldn't respond to a dynamic competitor. And there was some trucking regulation, but it was really very limited compared to what happened with railroads. By the time we got to the 1970s, rail was really struggling as an industry, and in particular in the East. And so we went through the consolidation and the creation of Penn Central in 1968. Then Penn Central blew itself up when we separated and created Amtrak in 1970 and Conrail in 1973. And so regulation and the government really became a way to restructure the railroads. When that point came along, I think was the point in which there was a change in thinking in economics more broadly about the costs of regulation. The early efforts, in particular in airline deregulation, sort of pointed the way. We went first to airlines, and then we did some financial deregulation with the SEC and deregulating commission rates and so on. So I think the financial deregulation, airline deregulation helped set the stage for 1980, which was basically then the removal of what was left of trucking deregulation and then the Staggers Act, of course. So by the time we got to 1980, the railroads were under a pretty constrained regulatory environment and had been that way for a long time. And so I think the changes in deregulation were so dramatic because the regulatory environment had been so tight.
So in what ways did freight rail, now post 1970, 71, we have to start talking about passenger rails and freight rails. And of course, as we've been told many times by one of our friends, before that, they were just railroads. But here we are. We're going to frame this as the freight railroads. In what ways did freight rail deregulation change the rules of the game for U.S. railroads? For instance, what were the immediate consequences in terms of contracting versus common carrier?
So prior to deregulation, there was a common set of prices that applied to all shippers. There were minimum and maximum rates. So if you wanted to haul grain from Chicago to New Orleans, you would pay a certain price per car or per ton. And it didn't matter whether you were shipping one car or 1,000 cars. The rates themselves didn't reflect the underlying costs of providing the service. So some services were really underpriced and some services were really overpriced. So it was this balancing act that the regulators had tried to keep what they called revenue adequacy to sort of earn a reasonable rate of return for the railroads. And so it was this unbundling of all of the commodities that railroads carried. So now I could price containers differently than corn or aggregates or coal. But the other thing it let me do wasn't just gave me pricing freedom, it also gave me the ability to do long-term contracts. So if I was CSX or Norfolk Southern, I could go to the coal mines and say, we're carrying a lot of your coal to power plants in Virginia and North Carolina. We'll do that on a contractual basis for 3 years at these prices. And so you could set long-term contracts where I knew I was going to get the shipping volumes, you knew what prices you were going to pay, and it introduced a notion of pricing that wasn't just pure spot pricing.
Right. And it's interesting because it's exactly the discrimination among shippers. So I'm just reminded of people criticizing the open access system in Europe by talking about cherry picking. So, in a way, isn't that sort of contracting going from tariff published set rates to private contracts that are not transparent, they're not publicly available, or they're not available to the shippers or the railroad's competition? That is a form of discrimination then. And wouldn't there be an impulse to cherry pick whose stuff you move?
I think clearly in a privatized profit maximization system, you want to serve the more profitable customers, right? And sometimes without the transparency of pricing and contracts, it does leave some asymmetry there. I think the other issue, though, is that it wasn't just that there were some shippers who were treated differently than other shippers. There were actually a set of shippers that were still captive to the railroads, right? So one of the legacies of rail regulation has been multiple attempts to try to think about how do I manage captive shippers, right? How do I make sure that the farming operation or the logging operation that only has one way to get its product to the broader economy isn't hijacked in terms of pricing. And so the remnants of pricing regulation led to some pretty high energy battles between shippers and the government and the railroads. The consequence of all of the changes in sort of contracting and pricing led to lots of incentives to say, well, look, I'd be better off as a shipper if you could take me all the way to my destination. And so that created incentives for network extension and for end-to-end services. And a lot of that, for example, is how do I get from the West Coast to Chicago? Or how do I get from Chicago to New Orleans? And so that's when you see Burlington Northern and Santa Fe merge, and Union Pacific, Missouri Pacific, and Western Pacific. And then in the East, the consolidation of Chessie and Seaboard Coastlines and Norfolk and Southern. That wave of mergers created what I might describe as sort of 4+1, two Western roads, two Eastern roads, plus Conrail. And Conrail was a government creation that actually Stanley Crane ran it really well, did a lot of things to improve the performance, but it was always sort of unbalanced of having two Western roads and three Eastern roads if you were going to have a connected system. And so the last wave of mergers was really the Conrail being split up into two pieces, in which CSX got the old New York Central and Norfolk Southern got the old Pennsylvania Railroad. And that's then created that balance of sort of two Eastern roads, two Western roads. Now, the reason I put that as prelude is that the other big effect of deregulation was it allowed the mainline class one railroads to abandon whatever tracks they wanted to. So there was an explosion in short line railroads as the mainline class one railroads got out of lots of thinner, more remote services, more infrequent services, and they got rid of all the track. A lot of what was divested became non-union. And so I think part of the issue of how do I manage the fact that I've got big railroads contracting with big shippers on extended horizons versus smaller markets served by smaller railroads with smaller shippers. And so I think we created this short line world that feeds into the mainline railroad. And it took probably 10 years for that to sort of get itself sorted. And then the last bit of Conrail sort of came in there. So I think the other big thing, I think we talk a lot about the mergers and we talk about the pricing and the contracting, but the development of the short line industry is the other big consequence, because in the pre-deregulation days, the 33 class one railroads ran all of the short lines as well.
Right. There were 8,000 miles of short line prior to 1980, and then there were 43 or 1,000 miles of short line in that period that you're talking about. And so that's a major shift. And I have heard that there were embargoing these branch lines that were less profitable for them or not profitable. And the old system found ways to balance that out. But when you relinquish control over pricing and you allow the spin-offs and abandonments of these either less profitable or unprofitable routes, that's got to affect the economy. To me, it looks a lot like a shift from like pruning the capillaries of the circulatory system and realigning for a transnational supply chain oriented economy. It's not that different from some like early like colonial railroads that are point of extraction to point of export that I see in Africa. But all of a sudden here, 1980, we start this pivot.
So take them one at a time. I think that there were a set of short line railroads which were not profitable if they were operated under mainline union contracts in which the old rates didn't cover the costs, right? So under a lower cost structure, the short line railroads could provide a profitable service that the mainline railroads couldn't. So in some of the short line railroads, what you found was once it got away from the mainline control, I could offer better services at better prices, and I could be closer to my shippers and work out how to better serve them. And that was probably most true in some of the agricultural shippers and some of the short lines there who were really good at managing seasonality and things like that. The second block would be the short line railroads, which were really marginal. Even after you restructured the costs, they were still sort of, it was hard to make money. And that's where I think the big question becomes, what's the economic transaction between the short lines and the main lines when they hand over traffic? And it's not unlike the situation in airlines where you have small feeder airlines going into hubs. So I think one of the legacy issues of the whole deregulatory experience has been that the shippers and the short line railroads together are still captive in some ways to the main lines. And then the third bit is just the abandonments themselves, which were a whole bunch of trackage that, it used to serve 4 factories in Western Pennsylvania and 3 of them have closed, right? And so a lot of the industrial restructuring that went on meant that a lot of the short lines didn't have the same volumes or customers, and the local municipalities could never keep up with enough of a subsidy. So I think there was a set that was a legacy of a 1950s industrial economy that by the time we got to the 1990s wasn't around anymore.
Yeah, it's a bit of a chicken and an egg situation, I would think, though, as well. And it becomes harder and harder to maintain an industry that's not scaled to compete with a transnational corporate entity that can offshore and outsource. It seems to feed on itself. So maybe you could clarify something for me. It's my understanding that a short line that's offering service to a customer that it needs to interchange with the class one, that they may be able to offer the service and they may be able to provide them with better, more flexible service because, well, the class one doesn't want to go there anyway. But do they get to quote them rates? Because if wheat originates in Lewiston, Idaho, and it interchanges in Ayer Junction along the Snake River, and it interchanges with Union Pacific, and Union Pacific takes it to the coast, to the export terminal, I don't think that the Great Northwest Railroad that's bringing it to Ayer Junction gets to say the price. My understanding is that they have to get the price from Union Pacific.
So the way I think about that is that because it's the feeder story, that price is going to be set between the short line railroad and the class one. And that's sort of driven by the volume that the feeder has and the consistency and the cost and the types of commodities and so on. So the terms of that are in one sense dictated by the class one, but it's also true that the class one takes into account how valuable or profitable that short line is now. But then that has the secondary effect where if we think about, okay, well, this is the price that we're going to go from northern Idaho to the Pacific coast, This is the price it's going to take to move that wheat. Then the short line negotiation is going to be with the ag producers, with the farmers and so on, or the grain elevators or whatever, to sort of say, okay, well, this is what it's costing me to move it for you. So this is what I have to charge you to do that. So I think there is a price taking model in this. It does take into account the volumes and the types of commodities and so on. But I do think that one of the consequences of creating two East Coast roads and two West Coast roads was it created more of a problem of captive shippers, more of a problem of short lines, and more power for the mainline roads.
Thank you for that. This brings up there are certain commodities that are never going to travel by truck. And that's wheat, coal, crude, and some hazardous materials. I think it's good for folks who are coming up to speed on this stuff to understand that there are exempted commodities and non-exempted commodities. And before 1976, there were no exempted commodities. Everything had a rate, or what they call a tariff, set. In 1976, we get fruits and vegetables exempted because they can go by truck. And then 1980, we get pretty much encouragement for the ICC, and maybe the ICC taking initiative to exempt everything except for those commodities like coal, grains, some hazardous material, and crude oil. So in a situation like that, there's a backstop for completely abandoning service to these captive shippers and short lines by they could go back to a sort of a pre-staggers tariff rate, or they could have a contract carrier. But for other commodities, does that encourage a demarketing of some commodities when they don't have a way to fall back onto a tariff system?
I think that the way that the mainline railroads often thought about it at that point in time was to say, look, what this really lets us do is, instead of carrying mixed trains on a manifest structure, this gives me the ability to do long-term contracts with large customers and large shippers, so I can build unit trains that I can haul what at the time were the core railroad commodities, right? So it was aggregates, it was energy, and it was agriculture and various types of energy, as you just described. And those were sort of the core that were not going to move by truck. The only competition every once in a while was barges, right? But that was limited. So railroads spent a lot of time building and optimizing their systems to run unit trains. And just about the time that some of the energy, like the coal market, started to fall off, was the rise of intermodal. So the Eastern roads had always had lots more competition from trucking because of the density and the nature of the markets. But on the Western roads, once globalization really took off, containerization became a huge thing. And so instead of just energy and aggregates and agriculture, it's now energy, aggregates, agriculture, and containers. And so when deregulation happened, nobody was thinking about how important the intermodal story was going to be. And so the railroads were fortunate that there was this big country we needed to get across, principally from Los Angeles and Long Beach, and how do we get it to Chicago? And trains were perfect for that. And so we ended up building unit trains for containers as well. So globalization kind of came at just the right time. And it gave them a way that they could compete with trucks, except trucks did the last mile.
Right. I mean, were that actually the case, because we have 1 trillion ton miles of long haul freight that's moved by truck. But I am interested if we could just step back a moment here, because we are trying to understand this movement towards unit trains. Like, I've heard about discounts at 26 cars and discounts at 52 cars, then discounts at 110 cars, depending upon the railroad. So in your research, where did you see those discounted rates for unit trains? When did that emerge?
I think what was really related at that point in time was power. And so, like your 2652 story, at what point do I have to add another locomotive, which adds another crew? And so it sort of became a, when does my costs jump? So going from the 27th car to the 40th car meant no more labor and just a little more energy. So the discounts and the contracting were based on, how did I add power and how did I add labor?
That's interesting, because I think of the way that it's not necessarily another crew on a locomotive, because they're connected to each other and remotely controlled, but it is another train start. It is another group of people putting together the train and then getting it out into the system. I mean, I can imagine that there are always incentives to move a full train of logs or a full train of coal. But is there any particular marker like post staggers where you see that becoming a dominant business model or strategy for the rail class ones?
Well, I think that if you have an economic model that sort of takes root, that's focused on how do I get to the lowest unit cost, then what that says is you build really long standardized unit trains and you take them from one point to another point as far as you can. And so that model was essentially one that built toward lowest unit cost, but it also came at the cost of service flexibility. So schedule reliability was not an issue. What that meant was that both the railroads and the shippers and customers had to build in lots of slack in the system because I don't know if the train's coming Monday or Friday. And I'm not quite sure how many cars are going to be on the train or how many carloads are going to be mine. So I think what happened during that period of time, it was a mindset that said, let's get a handful of shippers who are our main customers, do long-term contracts with them, and we're going to deliver it at the lowest unit cost. You couldn't do it the same way in the East because the distances weren't as far and the commodity mix was a little different, but you did it wherever you could. So coal for CSX and Norfolk Southern, a lot of the sort of ag stuff for Illinois Central and for Kansas City Southern were of that. So I think the model of run homogeneous trains at the lowest cost and essentially said, we're not going to think about the value of service, we're going to think about the cost of service.
We're not going to think of the value of service. We're going to think of the cost of service.
So one of the issues of the development of precision scheduled railroading was really how could we make train service more reliable and consistent, right? So I know that if I get my rolling stock to Nashville, I know it's going to Florida on a 10 o'clock departure. And so because we didn't have that service consistency, it meant that for shippers for whom reliability was important, it was pushed aside at the lower unit cost model.
So this is right where we want to be going and to better understand, because we've heard a lot of conflicting theories about and descriptions of what precision scheduled railroading is and what it isn't. And a lot of conflation. It's easy for folks from the outside to conflate unit trains and the profit maximization strategy for shipping those volumes with the profit maximization of PSR. It's helpful to understand that the unit train phenomenon is earlier than the PSR phenomenon. You mentioned Illinois Central, where Hunter Harrison, I believe, started, and they were running unit trains. And so I'm wondering if there's a bridge around profit maximization at Illinois Central that is kind of the precursor of later PSR stuff. I'm curious about that. I'm also curious about how the deregulation of transportation dovetails with deregulation of the financial sector.
So let's start with the financial and the transport sector. To me, the biggest effect in financial deregulation wasn't deregulation of commission rates and so on. It was essentially the ability to create index funds. Because you could buy and sell shares really cheaply, it led to a huge innovation of index. And so, Vanguard comes about because of this. John Bogle builds an empire at Vanguard.
What happened to do that? What shifted to make index funds possible? And when did that happen?
There were two things that really drove it. One was ideas, right? So capital model, portfolio theory, options theory, a whole bunch of financial breakthroughs that won Nobel Prizes later on, right? How do we think about investing? We learned about the precise mathematics of diversification and optimization and so on. And Bogle took those tools at Vanguard and said, we have a way so we could buy and sell shares and put them into a mutual fund structure where we could sell shares in the mutual fund. So everybody could be an investor if you had $100. And you could own a share in a portfolio that might have $1 million worth of stocks in it. So all of a sudden, we have mutual funds that create the opportunity for the average individual investor can invest in ways they can't before. And all of that then leads to 401k. But the other bit was we had a whole bunch of research that showed that markets were pretty efficient in the sense that it was hard to pick stocks and beat the market. So the lesson from that is get yourself invested and don't try to beat the market, just be diversified. So what's the way to do that? You buy index funds. With the creation of index funds, if you're running the Vanguard Index 500 fund or you're BlackRock running an index fund, the role that shareholders played as kind of oversight of management went away. Because Vanguard's index fund, their job is to just own the shares in the S&P 500. It's not oversight of the management of the companies in the S&P 500. So the historical idea was that shareholders had boards who monitored and oversaw the management of the company, in particular major strategic decisions or so on. Once we democratized finance in terms of ownership, the role that shareholders played in monitoring and managing and activism went away. And so Vanguard doesn't tell its investors how to vote. BlackRock doesn't tell its investors how to vote on board memberships and so on. We stepped away from that. And what that did was it gave management and boards more power than they had had historically.
Approximately when did that happen?
Vanguard starts in the mid 1970s. Basically, by the mid 90s, the shareholder market has completely changed. So it's about a 20-year period, 25-year period. What that really then did was the traditional shareholder oversight of boards and executives kind of became passive. Why that's important going forward is that the railroads got themselves into a position that I would describe from, say, 1990 to 2010, maybe, in the US of they were seen as mature, they were seen as established, they were seen as ones that had a sort of consistent operation that generated a huge amount of cash flow. So you could pay out dividends and buy back shares. And it was seen as a sort of boring, stable, predictable investment, not unlike sort of electric utilities. The reason why that's important is that when precision scheduled railroading came along, and I'll go to Hunter in a second, it came along at a time where what was being asked was we're going to fundamentally change the operating model of the railroads. But if we're going to do that, the railroads didn't want to change. So we needed a force to change them, which was the development of a new set of activist investors. And so I think one doesn't happen without the other. To go back then to the second topic, so Hunter Harrison had a long career in the railroads. And when he got to Illinois Central Gulf, if you think about the ICG, it was an in-between railroad. It was not one of the giants, and it had lots of mixed commodities. And so what he realized was, because I have a different kind of a railroad, what I want to do is get away from this idea of unit trains, and I want to change the operating model that says, let's not think about maximizing the homogeneity of the train and minimizing the unit cost. Let's think about, I have all this rolling stock and I have these locomotives and I have this labor, and how can I think about using that in a higher intensity way? So what I want to do is, instead of what they called hold for tonnage, instead of waiting to build a unit train or a mixed train that was go to a single destination, what I'm going to do now is I'm going to have a train that's going to leave. I always like to think about what you would do is build a train in Chicago. And if the train in Chicago was going to Nashville, to Atlanta, and to Jacksonville, you'd build a train, and the last cars in the train would be the ones that you would drop off in Nashville. And then at Nashville, we would add the cars that would be going to Atlanta. And the idea was we could do that on a daily scheduled basis that would create consistency in the operation. So we're changing from a world where we wanted to build homogeneous trains that were either homogeneous in terms of commodity or homogeneous in terms of destination. So that meant the entire railroad system was built on hump yards. You got to a place, you broke up the train. You broke up the train completely in Nashville. You reassembled one that would go to Atlanta. And that was very costly. So he wanted to increase the cadence of the operation and increase the utilization of the locomotives, the rolling stock, and the labor. And so that model, fundamentally different than what had been built over, let's call it 30 years in the US in deregulation. And what he had done was the Canadian Pacific and Canadian National had always sort of been ebb and flow in Canada. So when Canadian National acquired Illinois Central, back to your earlier point about globalization, we have NAFTA. It's really useful for Canada to be able to get to the US and to Mexico. Illinois Central did that. So Canadian National acquires Illinois Central, and as well, they acquire Hunter Harrison, who says Canadian National isn't as good as Canadian Pacific. How can we make this better? I want to take the operating model that I had at Illinois Central and apply it to Canadian National. And he did. And Canadian National had always been a bit more of an Eastern road anyway. And so the importance of Hunter going to Canadian National was it proved that precision scheduled railroading could be an operating model on a national scale, not just on a regional scale. That was a really big effect. And then he retires from Canadian National and then gets brought out of retirement by activist investors who say Canadian Pacific isn't doing as good as Canadian National. Can you come back and fix it? And that's how he gets to Canadian Pacific. And then eventually the activists move him from Canadian Pacific to CSX. The original story was Bill Ackman, who's an activist investor with Pershing Square, had taken a stake in Canadian Pacific, brought Hunter out of retirement as part of his bid. And then Ackman and Hunter had actually tried to acquire Norfolk Southern, but that was rebuffed. And one of the main deputies with Bill Ackman at Pershing was a guy named Paul Halal, who left Pershing, created his own hedge fund, Mantle Ridge, and said, I'm going after CSX. And so the way that precision scheduled railroading really came to modern US railroads, not ICG in the 1980s and early 90s, the way it got here was through activist investors who then went to CSX and said, your economics haven't changed, your costs are rising, we think we can run this better than you can, and you don't really have a clear management executive succession plan in place. We want board seats and we want to change the entire operating model of the company. And so I think the experience of Ackman and Hunter at Canadian Pacific then was translated to Halal and Hunter at CSX.
Okay. One of the reasons we wanted to talk with you is because you're one of the first people who makes this PSR thing sound relatively reasonable. Because there's a lot of folks who say it's neither precision, it's not about schedules, and it's not really railroading. To be fair, and going back to your point around financial deregulation, it is fascinating to look at the institutional investors having their hands in all these various railroads. And your explanation sort of makes sense for that because it's a stable, it's almost like government bonds, except with the shift in 1982 when the SEC opens up shareholder stock buybacks. Is there a possibility that the PSR, this relatively logical thing that you talk about that actually could result in better service and even potentially lower rates? Well, why are the shippers so not happy with the PSR they're getting and they're not realizing they got lower rates all until the sort of takeoff point of PSR, at which point it seems like rates have been going up since 2006, whereas they were going down prior to that. I mean, there's a lot of things to cover there. So I don't know how you want to parse that apart.
Let me start with just a couple comments about the SEC decisions in sort of 82 and then again in 83 about share repurchases. There were a couple of companies that time that realized that if I was going to spend $100 million on dividends, if I actually went to shareholders and said, I'm going to take the same amount of money, but I'm just going to buy back your shares, then you would get capital gains treatment and a lower tax rate on that than you would at dividends. So the original incentives for share repurchases from an investor standpoint was you got taxed less. But from a company standpoint, what the company soon realized was that share repurchases were way more attractive than dividends because with a dividend, I'm not legally, but in practice, you're committing. And so dividends were seen by companies as akin to interest payments on debt. You don't mess with the dividend. particularly for industries like railroad. So what did share repurchases let you do? If you had extra cash, you could buy back shares. And if you didn't, you could just scale down your share buyback program. So for example, if you look at Norfolk Southern's program, they ramped it up in the early 2000s. And then when the financial crisis came, they shut it down for a few years and then they brought it back. And so it gave companies way more flexibility in how to provide cash to shareholders. And there's an enormous set of issues. And I'm of the view that I think we've gone too far down the share repurchase story. And I'd like to see us get more back to dividends, but that's a different subject.
It's a different subject, but it's not irrelevant because it seems like there's a corrosive incentive that emerges as this realization that you're talking about takes hold. And then the stability that was attracting these institutional investors, it actually, for the long term, seems to be, if I'm not mistaken, threatened because there's a disincentive for long-term growth and investment in growth and capacity and marketing, and an incentive for cost reductions, artificially inflating earnings per share and rewarding even your management for the value of the stock rather than the growth in revenue.
Or the underlying operating economics of the business. The way that I think about this is that what's particularly damaging is when share repurchases are done at the expense of reinvestment in the business. I'm not investing in the capital. I'm not investing in new track. I'm not investing in new rolling stock. One of the things that's happened is we've created a world where in the old world, there used to be an expectation of dividends. Now there's an expectation of share repurchases. The original idea of share repurchases was if I had surplus cash after I made all the good investments I needed, but now there's a tension there. So I think that the big question is, do share repurchases reduce reinvestment in the business, especially in the core part of the business? So if I'm going to connect that to your comment of it's not precision, it's not scheduled, and it's not railroading, and one way to think about this is what you're really doing with PSR is you're running a just-in-time system. Everything is running at a particularly high cadence. Everything needs to run on time, right? And so think about sort of airlines. If you get a flight that's delayed, that cascades through the rest of the system, right? One of the real challenges with precision scheduled railroading was they said we essentially had all this capacity. We had more locomotives than we needed. There was more rolling stock than we needed. There were more hump yards than we needed. And we pulled a whole bunch of capital out of the system and we made it leaner and meaner. This is like just-in-time manufacturing for lots of industrial operations. And what it means is that if I have a problem, that problem cascades. So if I'm taking a train from Atlanta to Jacksonville, if it's late, that locomotive was the train from Jacksonville that was going to go to Miami. What precision scheduled railroading does is it means there's much less tolerance for error. There's much less slack in the system. And so when something goes wrong, it's a cascade. So what does that do? That means that schedules get broken. It means that there's really no precision because it's precision from the perspective of the railroad, not from the shipper. It does sort of fly in the, it's not railroading, but it's certainly a different notion of railroading, right? And suppose you're thinking about the way that Dell built computers, right? They had a whole bunch of equipment, whether that was semiconductors or boards or whatever, wires and so on, that all had to come together so we could make a Dell computer. That's what we're doing with precision railroading, right? So this is now just-in-time railroading, but it's not just in time from the standpoint of the inputs getting there. It's the whole system is now running on very small tolerances, right? And so when stuff goes wrong, it goes wrong quickly and in orders of magnitude.
Right. It's a cascading, as you said. The word efficiency gets thrown around a lot. And I really think it's a very tricky and slippery word because efficiency for someone is not necessarily efficiency for me. Resilience is more efficient for me. If there are multiple ways to get from here to the store, right? I get to the store regardless of whether there's an accident on the road. So for me, it's more efficient for there to be resilience in the system. And I wonder about that in terms of the railroads, because Post staggers, it's my understanding that rail volumes actually increased for a while as rates went down. But then there was another pivot where volumes start to go down and rates go up. I'm trying to understand and help others understand what's the relationship between that pivot and PSR.
So if I go back to that period where rates went down and volumes went up, a lot of that was the reset from the legacy of the distortions of regulation. And so now I could offer you a lower price and you'd agree to ship more volume. But eventually we get to a new equilibrium, which was the late 90s or early 2000s, something like that, where essentially there was no more adjustments to be made. So rates started to go up again. We had no more declining costs and costs started to rise. So then rates started to rise. And at the same time, as you sort of pointed out earlier, the change in traffic mix and the rise of multiple trailer truck operations and so on changed the economics of trucking a bit. I see the precision scheduled railroading as a response to the old world had run out of ways to improve and we need a way to compete with trucking. The problem is that in the end of the day, rail never is going to have the flexibility or the resilience of trucking. And your point on efficiency, I think that the notion of efficiency that underlies precision scheduled railroading is what's my return on invested capital? Can I provide a set of operations with fewer locomotives, fewer crews? It's about utilization. And it's about like how many hours of a day am I using or what's the dwell time in a yard and so on. And so these are productivity measures that are designed for optimization as opposed to your term's a really good one, resilience. And sometimes it's resilience in terms of a service disruption. Sometimes it's resilience in terms of, geez, the economy really took off and I have 20% more containers than I thought I had, and now I can't handle them, right?
Yeah, that had never happened.
Right. And so it's really challenged, not just with disruptions and resilience, but in terms of spikes. So you can see one of the knock on effects of that is when we start to get these surges, the average train lengths in PSR just exploded. And so you'd have towns that you'd wait at an intersection for train lengths that are a mile longer than they used to be. And they were all mixed, right? And once I start to mix cargoes, and I'm taking them through pretty dense areas, I certainly have safety risks and so on. So one of the ways that precision railroading responds to surges is it puts more pressure on the system. And there's more safety risks that come along with that.
Safety risks, derailments, et cetera. I mean, we were just interviewing Jess Conard from East Palestine. So this is very interesting because you showed that with PSR, though it initially is a stepping away from unit trains, the underlying motivations in PSR end up recreating or capitalizing on longer and longer trains, which we've seen.
They're longer trains, but they're heterogeneous trains, right? They're all mixed manifest trains now.
Right. So the phenomenon of fewer train starts, fewer crews, but greater utilization and less resilience in the system starts to impact external costs. So then you start to see the externalities of these efficiencies become less and less efficient for the public. The Congressional Budget Office did in 2015 a report on the external costs of freight on truck versus rail. The external cost of truck is like now adjusted for inflation, it's over 6 cents a ton mile, whereas it's like a half a penny or maybe 0.7 or whatever for rail freight. So the choice that sacrifices resilience and actually demarkets freight over to trucks has this very inefficient impact on social costs and external costs, if you will.
That's a really good point. And I think what we've done is that there are some of the costs of a high intensity operation like PSR that are born outside of the system. And I think your description of what we've done is we've created a new definition of a unit train. It just happens to be long, but not only are they going long, but the improvements in power and decentralized power mean that I can move not only longer trains, but faster. And I would say that from a operating and safety standpoint, this is a place where the regulators have really had to play catch up, because if you are thinking about a world where I'm overseeing safety and operational practices for long unit trains that run a couple times a week. That's a completely different model than every day at high intensity where I'm trying to make connections and so on. And the easiest way I think for the public to understand this is if we're running a system where when a train comes into a destination, it's on its way out. It's not unlike when you're at an airport and you're waiting for a crew to come, right? And you had that 30-minute connection at O'Hare that you hoped you could make. So we've taken that model. One of the legacies of transportation deregulation in general is we've made it this efficiency focused model that doesn't really have much resilience or much slack in it.
Yeah. So now bringing us back to this shift in the relationship to finance and the shareholder buybacks. So once PSR starts expressing itself in this longer and longer trains, et cetera, and it's not just about spending your extra money, but it's choosing and incentivizing the management and retaliating against management that do not operate in a manner that is oriented towards increasing earnings per share, lowering operating ratios, and doing stock buybacks. Where are the guardrails on this system for actually having infrastructure, critical national infrastructure, that's serving its public purpose, not merely its private purpose?
I think the shift over to PSR meant we took traditional metrics for the rest of the economy and applied them. So operating ratios became hugely important. Return on invested capital. What have you done in terms of be able to sort of make railroads more capital light, right? All of that became the scorecard. And in a world where we have passive index investors, that means activist investors can drive agendas and sort of say, look, we made these changes, and in the short run, it's about cutting costs, and in the long run, it's about generating more returns for shareholders. What comes at a cost of that is, are you making enough investment for the long term? Are you spending what you should on safety and so on? And I think we're at a place now where I think I'm not as close to this with the new administration, but I think the idea of a more robust safety environment was beginning to take root in DC. But the other aspect is, I think if you look at some of the most recent CEO story, like the CEO at CSX said, we may have gone too far on this. Our train inspections can't be as infrequent as they are, and we can't just sample inspection. So I think we've gotten to a point where the operating model is starting to affect the financial performance as well.
Shouldn't we also say that CSX CEO was then fired by the activist investors who had 0.02% of the shares of the company?
That's right. What we have is we have activist investors that drove a big change. And now I think we're at a place where my personal view is we need to find a new equilibrium. I think one of the things we always do when we make these changes, you have a wholesale change in an industry and it tends to overshoot, and then we have to rein it back in. And there's consequences, right? There's consequences for rates, there's consequences for service, consequences for safety. I was hopeful that one of the things that would come out of East Palestine was to think about this harder. And I think we did, but we've forgotten about it a bit. And the railroads have said, well, that was a particular set of circumstances. But I think there's some broader lessons here. And I would just say, think about, we had a series of airline crashes in the 1990s where it made us really rethink, what are we doing with airline safety? And I think we're not there yet with rail.
Sadly, because of all the derailments and all this, you think enough would be enough. And at the same time, I have to say that what they might be doing is they might be uniting inadvertently their opponents. So, folks who are coal shippers now have common cause with environmental justice and labor and public interest folks.
Completely agree with that. And I think what we had is an innovative, in the sense, it doesn't have to mean that it was good or bad, but a completely new operating model that was pushed through by financial markets. And now I think your coalition of the affected should have a voice at that table, right? I mean, we can't have a country that's run solely by what's in stockholders' interests, especially if those stockholders are just a small fragment of the total stockholders.
Well, Professor Strong, it has been a real pleasure to get to hang out with you. Thank you so much for engaging in what is a pretty intense Gordian knot to try to unravel, right?
Absolutely.
And it's not simple, obviously, and it really matters. That's the other part. There's real life consequences and long-term consequences. So thank you so much. I really appreciate you sharing your knowledge.
Happy to help, and I look forward to seeing what you're doing.
Awesome. All right. Have a great day.
Thanks, Bill. Cheers.
That was John Strong, CSX Professor of Finance at the College of William and Mary, in conversation with Solutionary Rail Director and Reconnect America host Bill Moyer. This conversation was edited for clarity and brevity by August Moore and me, Sasha Elenko. Thank you to Oda Proda for the theme music. You can find the show on Substack, Apple, Spotify, YouTube, or wherever you get your podcasts. You may have noticed that this podcast doesn't have ads or a paywall. With your help, we can keep it that way. Pitch in and get involved by visiting solutionaryrail.org. We're not here to sell you anything. We are here to build a movement.